Welcome everyone to today's Explainer. I am super excited to have you here because, wow, do we have a fascinating piece of institutional research to unpack today. We're diving right into the May 2026 Macroeconomic IA report, which gives us this incredible audit-level analysis comparing the massive United States real estate investment trust market, which you probably know as REITs, with the hugely popular Brazilian real estate investment funds, or FIIs. So whether you're completely new to global real estate or you're just looking to better structure your understanding of these two completely distinct vehicles, you are in exactly the right place. Let's get into it.
Okay, we have to kick things off with a number that's honestly a little hard to wrap your head around. $4.5 trillion. That is the gross asset size of the US REIT market today. Think about that for a second. We're talking about a globally dominant financial structure that holds some of the absolute most premium real estate on the planet. Literally everything from sprawling logistics hubs to the massive data centers that keep the internet running. So the key takeaway right out of the gate is this. When we study US REITs, we are studying the absolute giant of the global real estate market.
Section 1. The Giant. American REITs.
Now you might be wondering, who actually owns all of this? Well, what's truly wild here is the sheer reach. 170 million Americans, that is roughly half the entire US population, have exposure to REITs today. And you know, this wasn't some happy accident. It was by deliberate design. Back in 1960, President Dwight D. Eisenhower actually signed the legislation creating REITs with one specific goal: to democratize real estate. The government basically said, hey, everyday investors should be able to access diversified income-producing properties too, an opportunity that, up until then, belonged almost exclusively to massive institutions and the ultra-wealthy.
Section 2. The Rules of the Game.
So, what actually makes a REIT a REIT? Well, fundamentally, it's a special tax election under the U.S. Internal Revenue Code. It's not just a regular company. To keep this status, they have to pass a pretty strict checklist. First up, the shareholder test. They need a minimum of 100 distinct shareholders. Second, the famous 550 concentration test. During the second half of the year, no more than 50% of the shares can be held by 5 or fewer individuals. They really want that ownership spread out. Third, and this is a big one for investors, the minimum distribution rule. A REIT absolutely must distribute at least 90% of its taxable income to shareholders every single year. And finally, the asset and income tests. Basically, 75% of their assets must be in real estate or cash, and 75% of their gross income has to come from real estate sources, like rent or mortgages.
Section 3. REITs versus Brazilian FIIs.
All right, let's tackle the elephant in the room: taxes. This brilliantly illustrates a huge difference in how these two governments view things. In the US, a REIT avoids paying corporate tax on the income it distributes. It acts like a pass-through entity. But that tax burden doesn't just disappear. It's passed directly to the individual investor. So for a typical US investor, those dividends are generally taxed as ordinary income. In sharp contrast, down in Brazil, eligible retail investors and FIIs get to enjoy tax-exempt monthly dividends. It is a massive local incentive that makes FIIs incredibly popular for generating passive income.
Now, let's look at how this translates into currency dynamics, because this is absolutely crucial. If you're a Brazilian investor looking at US REITs, you aren't just investing in real estate anymore. You are officially taking on currency exposure. REITs are denominated in US dollars. This means every fluctuation between the dollar and the real is going to directly impact your total returns. If the dollar strengthens, hey, your returns in reals go up. But if it weakens, they drop. FIIs, on the other hand, are denominated in BRL, meaning there's zero foreign exchange risk for the local investor. It's just a very real layer of macro risk you have to factor in.
Structurally, these two are completely different beasts. US REITs are actual corporations or trusts, and the really massive ones, they're almost always internally managed. That means the executives actually running the real estate are direct employees of the REIT itself. Brazilian FIIs are totally different. They operate as closed-end funds regulated by the CVM, Brazil's version of the SEC. And by law, they require mandatory external administration by an authorized financial institution. So while Brazil's external setup is great for asset segregation, the US's internal setup is really what allows for that massive global corporate scale.
Section 4. Scenarios, Risks, and Performance.
People often think of real estate as this slow, steady, predictable thing, but honestly, it can be a roller coaster. Just look at the historical data for the FTSE Nareit All Equity REITs Index. In 2021, riding that post-COVID recovery wave, the index surged an incredible 41.3%. Huge gains. But then, literally the very next year in 2022, it dropped sharply by 24.9%. Why the sudden crash? Well, it ties directly to the US Federal Reserve aggressively accelerating interest rate hikes, which essentially crushes real estate valuations and drives up borrowing costs. By 2024, the market had stabilized to a modest 4.9% gain. So the big takeaway here is that publicly traded REITs absolutely can and do experience severe volatility.
Which brings us right to the sobering risks that institutional observers are constantly tracking. First up, as we just saw, interest rate sensitivity. It dictates borrowing costs, plain and simple. Second is property vacancy. Empty buildings mean declining net operating income, which is the core profit a property generates from its daily operations. Third, you have credit defaults. This specifically impacts mortgage REITs, or M-REITs, because they hold the debt rather than the physical buildings themselves. And finally, you have evolving IRS tax regulations. The rules of the game can change, like recent tugs of war and Treasury regulations regarding foreign ownership of domestic REITs. You always have to stay alert.
Section 5. Strategic Market View.
Now take a look at this strategic insight straight from the May 2026 data. While traditional sectors, think offices and industrial logistics, faced some headwinds or cooled off a bit in 2024, alternative sectors absolutely exploded. The specialty sector surged almost 36%, and data centers grew by over 25%. And the reason is simple. They are the physical infrastructure fueling hypergrowth megatrends like artificial intelligence. US REITs offer exposure to 14 different sectors, meaning you aren't just buying office buildings anymore. You can literally buy the physical footprint of the digital revolution.
To really ground this strategy in reality, let's look at a massive real-world example right from the SEC filings. Prologis, ticker PLD. This brilliantly highlights the immense scale of the US market we've been talking about. Prologis is a logistics giant. At the end of 2024, they held a staggering $95.3 billion in total assets, maintaining a 97.1% occupancy rate. Their core FFO, which stands for Funds from Operations, basically the main metric the industry uses to judge a REIT's performance, was $5.56 per share. It's wild to think about, but a single US REIT can hold a real estate portfolio larger than the GDP of some entire countries.
Section 6. Legal disclaimer and next steps.
Okay, quick pause for the mandatory legal disclaimer. Please note that this explainer, which is based entirely on the macroeconomy IA research, is strictly for educational, informational, and academic debate purposes. This is absolutely not financial, tax, legal, or investment advice. We are purely here to neutrally explain the structural mechanics of these global markets. Remember, past performance never guarantees future results, and you should always consult with qualified professionals before making any strategic or financial decisions.
So that leaves us with a pretty provocative question to ponder. Knowing what you know now, does the massive $4.5 trillion scale, the internal management structures, and that incredible cutting-edge sector diversity of the US REIT market outweigh the local comfort, the lack of currency risk, and the fantastic retail tax benefits of the Brazilian FII? It really is the ultimate question of global diversification versus local incentives, isn't it?
If you enjoyed this deep dive and you want to keep learning with us, here are your next steps. Make sure you access the links below to check out the source materials for yourself, and absolutely do not forget to follow the Macroeconomic IA channel. They are consistently putting out some of the most cutting-edge insights on macroeconomics, artificial intelligence, and technology. Stay tuned for their new publications, keep learning, and I will see you in the next explainer.